So if you read the financial press, you'll be well aware that they're constantly reminding you to use your ISA allowance, and particularly around the end of the tax year, which is end of March, start of April every year. This video is about what we consider to be the real ISA season, which is the start of the tax year, not the end of the previous tax year, but the start of the next tax year. And we're going to show you very quickly what we do for clients during this period. So let's just remind you about what ISAs are all about. So an ISA, if you break it down into three sections, we can first think about where the money comes from. So money comes from money that's already been taxed. So you've paid income tax on that, or it's money that's been in other taxable investments. When it's in the ISA, this is the main powerful feature of an ISA, is that it's a tax-free wrapper around some sort of account, usually a cash ISA being a bank account, or a stocks and shares ISA being some sort of investment product that would have a tax-free wrapper around it. And all growth and all income will be tax-free within that product while it stays within the ISA allowance. So it's a very powerful thing to use, and you should use it every year if you've got the money to put into it, of course. The other powerful aspect to an ISA is withdrawals, and it's often missed, this one actually, but if you think about it, if you put money into something like a pension plan, you're going to pay tax on the way out of that pension product, whereas with an ISA, once you've got the money in, which is obviously you've paid tax to get the money in, but once you take the money out for withdrawals, there's no tax either. So it's an extremely powerful way of saving for your future. Okay, so let's now just compare this to a taxable investment. So imagine you've got money in some sort of investment account called a general investment account, which invests in shares or funds or any kind of taxable investments. You know, the money on the way into an ISA or a general investment account is the same, but while it's in the account, that's where the ISA comes into its own, because it's paying no tax versus paying tax on income and capital gains. And if this was a bank account, you know, a cash ISA versus a standard bank account, you'd be paying tax on the income that you receive from your bank account. Of course, at the moment, potentially you won't be receiving much interest anyway, so there won't be much tax paid. And then if we compare that to taking the money out, again, withdrawals from ISA are tax-free, whereas you will probably or possibly pay tax on capital gains in a general investment account. So putting these things together makes us think about getting money out of taxable investments into tax-free investments. And not only should we do that every tax year, we should do that as early as possible during the tax year. And this is why the ISA allowance should be used as early as possible in April, rather than waiting at some point during the tax year when you get around to it, or potentially even at the end of the tax year. So let's just look at this in practice. Let's look at Mike and Julie, who've got some money in an investment. So you know, they've managed to save some money already, and we're just going to show you the effect of putting money into an ISA versus not putting money into an ISA. So I've gone too far. So they've got £200,000, and we're just going to show you the impact of 4% capital growth. So that's growth on the actual underlying investments, and then 1.5% per year dividends and interest, assuming they're 40% income tax payers, and they've got all of their allowances for capital gains and income tax offset for dividends and interest. Don't worry about this too much, but basically what we've done some calculations to show you how saving into an ISA, especially at the start of the tax year, will have a massive impact on the tax saving ability going forward. So let's look at this in an isolation now. So imagine this chart is showing you the tax saved compared to a single taxable account. So if we just go back up a step, imagine that Julie had £200,000 and she put it into one account in her own name in a taxable investment account. Believe me, we see this more often than you would realise. And she didn't use her ISA allowance, and more importantly, she didn't use Mike's ISA allowance either. Well, if she was to use both her ISA allowance and Mike's ISA allowance as early as possible in the tax year every year, and keep washing £20,000 into each ISA until everything is in all that £200,000 and the future growth are in ISAs, then this is the tax saving that she would make. So it's about £150,000 over 20 years. And of course, you can see that the tax saving gets bigger and bigger because compound interest works in their favour over time. If she was just using an ISA in her own name, she would save a bit less because, of course, she's not using both ISA allowances. But eventually, she would be saving about £140,000. So it pays to use both ISA allowances where you've got them. But even if you're a single person, you can make significant savings on tax. And this is not even considering the capital gain that she would have made, hopefully growing this money over time. This is just the tax saving that she would have made, putting that £200,000 into tax-free accounts over time. So why aren't you using your ISA allowance? And more importantly, why aren't you using it as soon as you possibly can throughout the tax year? This is looking at the percentage of tax paid on a total withdrawal. So imagine Julie put the money into a taxable account, let that money grow at the rates that we said, the 4% and the 1.5% for the income and capital interest, and that accumulates over time. Well, eventually, if she made no other changes and just let that money grow and took that money out from a taxable account, she would pay nearly 20% in tax, in capital gains tax at that point. So, and the other taxes along the way, by the way. So we have to bear in mind that the ISA can get it down to nearly zero because she would have paid some tax along the way during the time of the account, but she's almost paid no tax. So that's how she can make a massive difference in the tax taken from the account over time. Okay, so just to remind you, this is what we do for clients. So we have a service which we call Prosper, and it looks at how to make sure you don't run out of money in the future. We look at your future financial planning, and we also help you to manage your investments. But as part of that kind of ongoing service, we help you to use your tax allowances. And ISA season is one example of how we help you to use your tax allowances as early as possible. So to us, ISA season is in April, not March. You should top up your current allowance as soon as possible throughout the tax year. And at the end of the tax year, if you've got any left, we'll remind you to top that up if you've got money available. And as soon as the new allowance comes in, you should use that as soon as possible, as early as possible in the tax year. So the other thing that we'll do is we'll make sales from your taxable investments in March to use your annual allowance for capital gains tax, but buy into the ISA in April. It's a slightly complicated process, but basically what that does is it retains your tax-free capital gains tax allowance for the following year in its entirety where possible. So all these things are small things, but necessary things to retain allowances and to save tax as widely as possible. You have to ask yourself, are you going to do this yourself? If you do, it's easy to do, obviously, but it's about being disciplined and having a process to do it. And a part of our Prosper service is to help you to do these things automatically without having to think too much about it. We'll tell you what needs to be done. If the money's there, you'll say yes, and we'll just go ahead and put it into action for you. So this is how it works. Imagine you're Julie, you've got £200,000 in a taxable investment account. As soon as April comes round, we're going to wash £20,000 straight from one account into another account, from taxable into tax-free. So moving from the taxable investment account into the tax-free ISA. And of course, if Julie's married, she'll do the same for her husband, assuming they get on very well. And as I said, in March we're going to use any unused capital gains tax allowance, and that's going to reduce the tax in the future on this account here. We're going to make sales in March, put the money into the ISA in April as soon as it comes around. It's a technical, complicated scenario to do from an administrative perspective. We're used to doing it for dozens of clients every year, and it's just a simple process for us to do. And you'll just watch your money move from taxable to tax-free. Okay, so over time, let's just remind you, if Julie and Mike were to use their ISA allowance at the end of the tax year, rather than at the start of the tax year, the difference is quite staggering over 10 years. It's 3,143 in that scenario with those assumptions. So it's quite a significant thing to wait to use your ISA allowance. This is why you've got to use it as soon as possible, as early as possible during the tax year, and that way you'll save even more tax over time. Okay, so this is just one aspect of what we do in our Prosper service. This information explains a bit more about it. If you're interested, have a look around the website, and I'm sure we'll be delighted to speak to you if you've got any questions.